All right, so once again, good afternoon. We'll be continuing from where we stopped last week. I think to this end, we've been able to complete revenue. While I still expect that as time flies, you will have more questions, whether on the job or in your discussion with colleagues. Today, let's quickly go straight to what we have. IAS 2, inventories. That's exactly the wording used in the standard. It's not inventory, it's inventories. So I want to stand on the existing protocol. I'm still adequately called, I'm not changing my name. So not much to be done in IAS 2. We'll be looking at the introduction to the standard, vis-a-vis a brief history of the standard. What is the intention of the standard IAS 2? What are the scope of the standard? What are the measurement criteria for inventories? And we look at how do you value inventory, which is embedded in the measurement of inventory. Then at what point do you recognize on the face of your account inventory? How do you do the first time recognition? How do you do subsequent recognition? Then how do you present the inventories? And lastly, the disclosure requirements, right? But before we go to the main content per se, let's test the waters. Let's test some of your proud entry behavior on the subject of this course. Dash are those indirect costs of production that remain relatively constant regardless of the volume of production. Dash are those indirect costs of production that remain relatively constant regardless of the volume of production. Any idea? Yeah, fixed overheads. Fixed overheads. Because I use the word indirect, so that tells you it's an overhead. Inventories are measured at the lower of dash and dash. Okay. Dash are those indirect costs of production that vary directly or nearly directly with the volume of production, such as indirect materials and indirect labor. Variable overheads, because they use the word indirect. Okay, dash is the effective date of the revised IAS 2. What was the effective date, or what is the effective date? Oh, you can't remember. So let's write. Yes, you get it as we go on. So just like we did when we considered revenue, IFRS 15, we will do a brief history. How do we come to the current position where we are? What were the position before? What is the name it was called? What are the composites of it? What does it cover? What does it not cover? In April 2001, the International Accounting Standard Board adopted IAS 2 inventories, which had originally been issued by the International Accounting Standard Committee in December 1993. So I know we've talked about this before now. The standard setting body, when we were calling the accounting standard IAS, was IASC. So upon the transition from IAS to IFRS, the standard setting body's name also changed from IASC to IASB. So there was an initial position of the standard as at 1993 that was changed in 2001, but that doesn't mean that was the effective date. IAS2 inventory replaced IAS2 valuations and presentations of inventories in the context of the historical cost system. This standard was initially or originally issued in 1975, right? Why do we say then that IASB adopted it in 2001? Because that was when IASB became effective. So they adopted all the existing or substantive standard and began to refine or revise them where it becomes very necessary. Is that clear? So in December 2003, the board issued a revised IAS2 as part of its initial agenda of technical projects. The revised IAS2 also incorporated the guidance contained in a related interpretation. Can somebody remind us what we call SIC? Why was SIC there? What is the full meaning of SIC? Okay, that provides interpretation for what? As at when we were using which standard? IAS, exactly. But when we transited from IAS to IFRS, the interpretation committee then becomes what? IFRS. So there was a position that an interpretation made by SIC then on IAS2 that was called consistency, right? So this was revised as at that date, which also provided different cost formula for inventories, right? Other standards have made minor consequential amendments to IAS2. They include IFRS 13. So IFRS 13, sorry, I wanted to indicate fair value. They're not that fair. So IFRS 13 made some minor changes to when we use the word fair, what does it actually mean? So that particular interpretation was extracted from the provision of IFRS 13. So then IFRS 9 also makes some clarifications or a little amendment to what were the scope of financial instruments that were within the coverage of IAS2, right? Then IFRS 7, what is IFRS 7? No.
Oh, IFRS 7, that should be financial instruments. Not presentation of the
presentation. All right, so there were some parts of it that relates to talkings around IAS2 that was insignificantly amended. Then IFRS 15, we had a talk around that the last time. So it also makes some little amendments. Under what instance do you think IFRS 15 relates with IAS2? The standard provides that when you have incurred any cost on inventory, whether arising from the inventory from what you have produced, which you have accumulated is cost based on the standard costing technique, or where you have actually purchased for resale, whose cost must have been accumulated using the retail cost method, right? Until when this particular portion or all of the inventories were sold, you cannot recognize the proportionate portion of what has been sold, which you have reported its revenue as with its related expenses. What am I saying? I have 10 iPhones. Are we together? Now, until when I sell or when this is sold, it still remains my inventory because the intention is for sale, right? So the moment I made a recovery due to sales on the iPhone, I will recognize my costs, my revenue, right? Then the proportionate cost of the portion of the inventory that has been sold must then also be recognized. That's what the standard is trying to say there. So you are not necessarily strictly adhering to what IAS 2 says, but what IFRS 15 has said that the matching cost of the revenue as a portion of the inventory must be reported as appropriate. Then IFRS 16 also made some minor amendments. Any question? So I haven't done that brief origin of IAS 2. What then were the objectives? Why do you think the standard actually introduced this? What do you think the standard hopes to attain? Every standard you have issued for this purpose has certain objectives. As we are, also as human beings, we also have objectives. You have an objective you seek to attain when you set out for this class, right? So the standard provided the following as part of its objective. 1, prescribe the accounting treatment for inventories. So everything that is within the scope of IAS 2 is provided for, within the standard. How do you report? At what time do you record expenses? How do you recognize the cost of an inventory? What will be the recognition criteria? What is the measurement criteria? How do you disclose it? Everything is embedded in various accounting treatments, right? Then 2, it provides for method for determination of the cost to be recognized as an asset and carried forward until the related revenue are recognized. You remember I said something about the portion of minor amendments made by IFRS 15 on IAS 2. When the goods that qualifies as inventory has not been sold, you will continue to perpetually recognize every related cost that puts it in its disposable form as inventory, right? But the moment the inventory then becomes sold and you have fulfilled all the expected or the promised performance obligations, right? IFRS 15 then take it from there that the compensating cost of the revenue you have realized must then be net from the inventory and reported as an expense. Until then, inventory will be an asset. Is that clear? So we need to diligently look out for these when we are preparing our financials. At what point do you have the cutoff when you cease to report certain accumulation of costs as an inventory? At what point does it become an expense? Then it provides guidance on the subsequent recognitions as an expense, including any write-down to net realizable value. Under which instance could you have the adoption of net realizable value as a method of valuing your inventory? When you have an inventory, let's still make reference to the iPhone. I bought the iPhone for sale at, can you adjust a little bit so that you can see? I bought the iPhone for resale at 100,000 each. I will perpetually continue to recognize this as 100,000 until what the standard has provided that warrants me using net realizable value. What are those factors? Let's assume this iPhone 8 Plus, right? Let's assume we now have iPhone 16. So this particular model becomes obsolete such that it loses its real value. So the then realizable value, that initial cost I had earlier recognized was the actual cost before the markup for the sales, right? So now people or customers are willing to buy it at say 85,000 below my cost, right? So it means I would cease to recognize the costs. Meanwhile, the initial cost I had recognized could have been ascertained using either of these two methods, standard costs or retail costs. You use standard cost when you are the one that produces it, because you would then have to look at what is the fixed cost of the proportionate portion that relates to the good that you have produced from the apportionment you have made on the fixed cost. What is the portion of it that is the variable cost, right? What is a portion of it that is the variable overhead, and what is a portion that is the fixed overhead? All that, using our costing approach, gives us a standard cost per unit. But if I am not the manufacturer, I definitely will not be using standard cost method. I'll have to look at how much does it cost me to buy. Do you understand? That then becomes my retail cost. But having incurred that sum, right, and willing buyers are now pricing fairly that same product that originally cost 100,000, they are willing to buy it in a fair market price for 85,000. The standard says you cannot continue to carry such inventory at a cost, at a value lower than this cost. Do you understand? Because if the original cost you've been carrying is still 100, but now it is actually being priced at a lower sum. Even though we have not sold, the standard says reduce the cost. That's what that objective 3 was trying to communicate. Let me take that again. That provide guidance on, that is the standard, provide guidance on the subsequent recognition. We have earlier recognized it, right? Even though we have not sold, but the value has been depleted, right? So one has to, in line with the standard, you have to also adjust the cost as appropriate, as an expense, including any write down to net realizable value. So when you are then writing it down, you are writing it down from the inventory, which is a current asset item, to where? To expense. But factors that made it lose its value could also reverse itself. When it then happens, the standard still provides, we see as we go on, that you can also write up the cost, but you cannot write up its cost above its original cost. So if standing using my earlier example, it is still 100,000 originally, has been written down to 85,000. We now find out that due to factors beyond our control, not influenced or induced by us, the cost of this particular, the realizable value has now appreciated to 120. You cannot recognize 120. You can only write it up to the cap of what it was originally. Do you understand? Now it is 15, not 20. 85 before, from 100 to 85. So you are then now recognizing other incomes like a recovery. The same way you will have had bad debt written off, now recovered. So you are crediting that other income and debiting the inventory back. You know, earlier when you are writing it off, you credited the inventory and you debited the expense. So you have to reverse it. Do you understand? But you need to be mindful of what segment of the income statement you have earlier written it off to. Ordinarily, it is expected that you will have written it off within the comprehensive income. The original income statement, not the OCI. But if you have earlier written it off to OCI, you then have to go back there and recover it back. Do you understand? Is that clear? But why it becomes very necessary for you to have adjusted for it in the initial income statement, but not in the OCI, is that particular diminution had already occurred in the course of your normal business. What is the intention for which the business was set up? To sell the inventory. So it should not be an OCI item, right? Then it also provides guidance on formulas that are used to assign costs to inventories. So it tells us what method should we use, which is valid, which is not, which is recognized by the standard, which is not, right? I'm sure, okay, let me put you to test. What are the methods or the formulas that you are aware that the standard recommends that we should use when you are valuing cost of inventories? Okay. Okay. Are you sure? No, the one mentioned by the standard. Okay, the ones you know. The ones you know. All right, so we'll see as we go on. Okay, so I haven't covered what the history is and what do you call it? The objective. Now we are looking at the scope. The scope tells us what are the limits or the coverage of the standard. What are the things it does not cover? IAS 2 shall not apply to all inventories except financial instruments as covered by IAS 32. Financial instrument covered by IAS 32. So if you have any aspect or the aspect of financial instruments that talks about valuations of certain financial instruments, whether assets or liabilities or equity as the case may be, because there has been a very specific standard for it, it is not within the scope of IAS 2. So financial instrument presentations and that of IFRS 9, financial instrument itself, right, is not covered by IAS 2. So there is nothing we'll be talking about in IFRS 9 and IAS 32 that will be making reference to anything as noted in IAS 2. Is that clear? 2, biological assets related to agricultural activities and agricultural produce at the point of harvest. So anytime this aspect of IAS 41 agriculture that talks about that whenever you have biological assets relating to agricultural activities or agricultural produce, the standard there coincidentally say you should value at the lower of costs or net realizable value. But it is as specified by the standards. It's just coincident that there are certain circumstances where IAS 2 say we should use it. Do you understand? It was just the provision of that standard alone. So when you are making reference to such, don't say IAS 2 says we should treat agricultural produce or biological asset arising from agricultural activity as such. It is not, right? Then we've been talking about inventories. What then is an inventory? Inventories are assets. It is very important to note that they are not expenses, they are not liabilities, they are not equities, but rather they are assets. What makes them an asset? It is expected that the entity holding such assets will have incurred costs in the past, hoping to putting it through sales to economic use to realizing what future economic benefits. That is what's made in an asset. So if you have costs that you have incurred on certain items that looks like an inventory, but you don't have any intention to selling it as a tool to recovering the economic benefits, it may then not qualify as an asset within the context of IAS 2. Probably you then have to reclassify it into other form of assets that will be covered by another form of standard. Do you understand? Let's give a typical example. We are into the manufacturing of ACs. As long as we continue to manufacture, the ACs that have been fully produced then becomes our inventories. Do you understand? But the moment we now say we want to make use of some in the office, it ceases to be our current assets or assets within the context of this standard, even though it's still an asset, but it's an asset with a different objective. Do you understand? So what IAS 2 regard as assets could be, you will see as we go on, materials that we have that we have acquired with the hope of putting it into a production process to manufacturing a different output. Or a fully produced output, which we then call finished goods. Either the one we have manufactured ourselves, the output of that production process, or the ones we already go to the market to buy as a ready-made goods. Is that clear? Or the raw materials have been put into production process, but the whole productive process has not been completed, which we then call work in progress. So it can be in any of this form. The standard recognizes that, right? So going on that, inventories are assets. At least when I now say asset, you know where I'm coming from. Good. So inventories are assets held for sale in the ordinary course of business. So if I have certain assets that are held for sale, not in the ordinary course of business, it doesn't qualify as an inventory. Who can give me a typical example of that? I have assets that I've held for sale, but not in my ordinary course of business. Who can give me an example of that and what standard talks about that? Okay, let me give you a typical example. Our firm renders accounting service, tax services, and training services, right? We have two distinct buildings in our corporate name, this building and the next one. We now decide, initially we have staff that occupy the whole building. We now decide to say, oh, maybe because we are now adopting work from home model, we don't need the whole of the two buildings. We decide to advertise for sale one of the two buildings. Do they qualify as our inventory? Does that qualify as an inventory?
No.
Why? Because we are not in the business of selling building. So even if I have things I've held for sale, out of my ordinary course of business does not qualify as my inventory. What standard takes care of that? Building. It is an investment property. Any investment property IAS 40 talks about there are two things that can come under it: land and building. If you are not in the business of using that land as your inventory, just like I said, we render this service, but we have unutilized portion of the building, which we now lease or we decide to sell. It will not be accounted for under IFRS 5. It will be under IAS 40. Anything land and building. Within that illustration, it will be a different thing if my firm is a real estate. That qualifies as our inventories. Do you understand? So held for sale in the ordinary course of business, then the second one is in the process of production for such sales. I earlier explained that we could have raw materials that comes in there, you could have work in progress that comes in there, you could have a finished goods that comes in there. Then the next one, in the form of materials or supplies to be consumed in the production process or in the rendering of services. Does it mean as we operate, as we render a service or in the service industry, does it mean we cannot have inventory? We can. we can. The unused portion of our stationery qualifies as our inventories. Do you understand? So, because we acquired it with the intention of using it up as we produce or render our services. So, all of these could qualify as assets within the concept, within the limits or scope of IAS 2. As simple as it appears to be, it can be misinterpreted. Do you understand? Yes. And we always say that the way you present and disclosures you made around all of these informed taxes that will accrue on it. Any question? Okay.
The statement about how it seems so simple when I was once a finance manager in an NGO.
Okay.
An NGO whose focus activity is education, training students and all that. And we use different manuals and materials for it, which of course will be paid to get. We don't buy really, but someone. Okay. So what we buy, we then were accounting for as inventory. Because
You don't buy.
You buy. We were using those materials, those manuals, those educational books in the rendering of ourselves.
How do you get those materials?
We buy them.
Okay.
Yeah. And then we account for them as inventory.
Okay.
Until the auditors came and said they didn't qualify as inventory.
Okay.
And then we got into this argument back and forth that
okay.
if they weren't inventory, they are worried.
Okay.
And you call this PP. This is cool. There was that back and forth there. All that. So
sorry, because the motive then is if after the educational activity, do you collect them back?
we collect them, but no, because we give it to them.
You give it to them. So it's your inventory. It's your inventory.
So that argument then, there was complicated, complicated. Yeah. He said it wasn't inventory.
It's an inventory. What then do they call it?
Oh, that's
All right. But at least it's convincing. What is your main line of business? It is relating to it. And it is being used up as you render that service. It doesn't qualify. You cannot, I don't know. Sorry. Okay, still under that, what an inventory is. Cost incurred to fulfill a contract with a customer that do not give rise to inventories or assets within the scope of another standard are accounted for in accordance with IFRS 15. That was the area I was earlier trying to explain that IFRS 15 made minor changes to it. Right? I'll take that again. Cost incurred to fulfill a contract with a customer that do not give rise to inventory, right? Mm-hmm. Or assets within the scope of another standard are accounted for in accordance with IFRS 15. So, of course, when I want to render service to my client, depending on what sort of service I'm rendering, there are bound to be certain costs. Some of those costs are portions of that inventory that we used up in rendering the service to them. So this standard is saying that which you then take it off from IAS 2, say that at that point, since it then becomes like my input costs to rendering or earning that revenue, it ceases to be an inventory. It will then be accounted for as expense to that revenue I've earned, which is what we could then, depending on whether it's a trading company, you can then call it cost of sales. Do you understand? If it's a service company, you can then say cost of service. Do you get what I'm trying to say? So that is why you will then deplete the inventory balance to the extent of that portion that has been used up, and write it up to the expense and match it with the revenue you have earned on it. Because we have earlier said that inventory within this scope is an asset. It means it will perpetually be in your statement of financial position. So at the point that it then becomes a contributing factor to earning that revenue, it ceases to be an inventory. It has fulfilled its own obligation, right? So you then have to reclassify into an expense and recognize the matching or corresponding revenue from it. So then we need to emphasize that the effective date of the revised IAS 2 inventory is January 1st, 2005. We had mentioned that ordinarily IAS 2 has always been as late as when? You remember I mentioned it? 1975. Then it was not called inventory, even though it was still the same IAS 2. We call it valuations and presentations of inventories. It was adopted in 2001 by IASB. It did a lot of amendments, corrections, updates on it. That update then became effective with effect from what? 1st of January 2005. Is that clear? All right. So those are the basic things within the scope of the standard. We've earlier said that portion of this or transaction relating to what IFRS 15 has covered cease to account for it in line with IAS 2. The portion that has been covered by IFRS 16 cease to account for it in line with IAS 2. The portion that has been covered by IAS 32, financial instrument presentation, cease to account for it in line with IAS 2, right? Then measurement of inventories. How do we measure inventories? I've said it that every standard, or most of all the standard, gives provisions around definition of key terms, what is the name of the standard, what is the scope of the standard, what is the standard seeking to attain or as its objective. Then it will give you measurement criteria. How do you measure this particular standard under this course? Do you understand? At what point do you initially recognize it? How do you subsequently recognize it, right? How do you present it? Then what disclosure requirement is expected of you? So I remember then when we were preparing for ICANN, the lecturer will always say, Vincent, then I remember him vividly, we always say, you don't need to cram anything. But when you pick any standard, know its objective, know key definition, know the scope, know the measurement provisions or criteria, know the recognition criteria, know the presentation, know the disclosure, and leave the remaining. Do you understand? Because some standard, if you look them from the raw document, I was looking at IFRS 17 yesterday. The standard is about 188 pages. Right? So many topical issues to discuss there. But do you have to cram the whole 188 pages? You don't have to. Just pick the relevant things around the factors or issues discussed there, then let the stories be. Most of the stories are around issues that make you actually understand what the provisions the standard has made. So according to IAS 2, inventories are measured at the lower of cost and net realizable value. What is the cost? What is the net realizable value? You need to know what it means within the context of the standard. I bought this phone on the Highland for 150. It cost me 5K for transportation, and other logistic costs is 2,000. How much is the phone? $150. 157. Okay, why? That your opinion is corroborated by which standard? So that is why the standard decided to go further to explaining what it means by cost of inventory. Let me give you another typical example. I bought the laptop, this laptop, for 500,000. It was imported. The importation cost, including VAT charge, with the hope of selling it. With the VAT charge, everything, let's assume it sum up to let's say 10,000, right? Because I want to sell, how much is the cost of the laptop? Okay, 510. Okay, Mr. K, how much is the cost of the laptop?
You bought it for 500,000. With VAT, then the other 500,000.
No, the VAT is 10,000.
Okay, it's 10,000. As long as that VAT is recoverable, it's 500,000.
Okay, that is a very cogent point. The standard you will see as we go on saying that where the incidental taxes you incur is recoverable, you don't accumulate it as part of the cost. You understand? But where it becomes irrecoverable, depending on what is the VAT legislation on that type of good. Is it a vatable good? Is it a zero-based? Who are you also selling to? Even if it's a vatable good, if you are now selling it to entities or institutions that are VAT exempt, right? I'm selling a vatable good to an NGO, which should not be which should not pay VAT. At what point do I then recognize, or what treatment do I give to that cost? Even the tax law, VAT provides that you can then accumulate that tax incurred, that tax expense as part of the cost or expense you have incurred in the course of the sales. Is that clear? Lizzie is looking at me as if I'm just speaking in tongues. No. You understand? Okay, okay. Sorry, I'm trying to bring this back. The internet is fluctuating. No, it's not that one. It's not that one. Check the clip right now.
So do you know what I mean for the NGO now? If at one point I'm not going to
Because what you are selling is not, the sales is not made entirely to the NGO. If it's entirely with the sales, you then capitalize it with the assets. because you know that this thing is not recoverable. But because some of it may not be sold, may be sold to entities that are actually VAT liable. So if you decide to capitalize it, you are actually defrauding the government. So what you would then have to do is, at the point when you now incur, you make sales to those who are not actually VATable, that VAT element, you will expense it. You will expense it. Then the tax law actually makes two provisions. Where you cannot, where you don't have the option to expense it, you can claim tax credits. Do you understand? But the most convenient with the procedure to claiming the credit is more complex. It's more complex. They will give you the money eventually if it is found out that something happens, but it is more complex. So best thing is treat it as an allowable expense, and you have your documentation to show for it. Okay, so this is where we are. So the cost of inventory shall comprises of all cost of purchase, every cost of purchasing it, that's one. Cost of conversion, right? If it is a product that requires further processing, right? Then you have conversion costs. Then other costs incurred in bringing the inventories to their present location or condition where it can then be sold, right? We form parts of the inventories, right? So if you purchase an inventory and the cost of the haulage and the carriage within the purview of the interpretation given by this standard, does it qualify to be capitalized? Yes. Look at the last one. Other costs incurred in bringing the inventory to their present location or condition. Not the one you, not the cost you incurred in providing other after-sales services to your clients or your customer. No, that's a different thing. So 2, please don't misunderstand. We are still explaining what cost is. We have the cost of the inventories. We have cost of the inventories could be cost of purchases. It can be cost of conversion alongside with other costs. So we pick them one after the other. The cost of purchase. This comprises the purchase price, import duties, and other taxes, other than those subsequently recoverable by the entity from the taxing authority. That relates to the explanation or illustration we earlier gave. If it is recoverable, then it doesn't form part of the cost of the purchase. But if it is not recoverable, then it forms part of the cost of purchase. Then transports, handling and other costs directly attributable to the acquisition of finished goods, materials, and service, right? Now, it also includes trade discounts, rebates, and other similar items are deducted in determining the cost of purchase. So that will have a deductive impact on what informed your actual cost of purchase. Then the cost of conversion. The cost of conversions of inventory includes costs directly related to the unit of production, such as direct labor, right? Then they do not include a systematic allocation of fixed and variable production overheads that are incurred in converting materials into finished goods, right? So all of these costs are costs of providing further processing activities or value-adding activities on that input before it is being sold. It may not be peculiar to all companies, right? A company can decide to buy certain phone. I recently heard that as you can have electronics being sold in your name. Do you understand? You can have a car that is branded and being sold in your name. Just go to the manufacturer. They will manufacture purely for you. They will now brand it. Then have KUs. Everybody start using a car called KUs. Sure, you understand? So if you're doing that, because you don't have the assembling plant, right? Everything you incur on that then forms your cost of purchase. Cost of conversion will then be the rebranding. Do you get it? Because they will just produce or assemble without attaching any name to it. Is that clear? Then they do not include a systematic allocation of fixed overheads or fixed and variable production overheads that are incurred in converting materials into finished goods. That would definitely, separately be written off. So you will not have anything overhead, don't add it to it. If you remember what you did in cost accounting, can you remember some of the topic, the costing techniques? What are the 2 costing techniques that we considered there? Yeah, hey, you are there. Marginal and what? No, absorption. You remember that marginal don't reckon with anything overhead. Do you understand? So what the standard is eventually reckoning with is the marginal cost. Even though they don't use the term there, but they have told you here that anything overhead is not reckoned with. Is that clear? Then fixed production overheads. Now, just trying to explain what variable and the fixed overheads are. Fixed production overheads are those indirect costs of production that remains relatively constant regardless of the volume of production. Right? So you will not say, can somebody give me an example of fixed production overheads? Rent. Rent is a typical example. If we are producing laptop and this is our production factory, this particular space, the rental space, has a limit. Maybe it can contain 1,000 laptops. So provided we are producing within that range of activity, it remains fixed. Do you get that? It remains fixed, right? So that is a typical example of that. Then variable production overheads are those indirect costs of production that vary directly or nearly directly with the volume of production, such as indirect material and indirect labor. Right? Can you give me a specific example under indirect material and indirect labor? The cleaners that work in the factory. So what extent can you say if a cleaner clean the whole of this place now? How can it be apportioned to each unit of output? It's very difficult, right? So it's an indirect labor. What is the indirect material? Consumables that we use. Maybe we have a particular kind of bleach or whatever we use in cleaning. After we finish the whole cleaning, how can we say that this particular one, I remember vividly when I used to work during those hustling days, when I used to work in a bakery. I was not a baker, right? But I was part of those auxiliary staff that will come and clean the baking pan. When they finish baking, I will offload the oven, then remove the bread, arrange it in the baking tray and the likes. Now, there is a substance, butter and something that we use to clean the baking pan. The essence of that is such that after the baking, the loaf can come out unaltered. Do you understand? Now, what portion of a bucket of butter can I say that I use in moisturizing a baking pan? Very difficult, right? That's maybe a typical example of the indirect material. So it then depends on which particular production process are we looking at before we can then say, oh, this is variable overheads, this is fixed overheads, this is direct costs. Are we there? Allocation of fixed production overheads to the cost of conversion is based on the normal capacity of the production facility. Now, I need to make an emphasis here, a little deviation from what we're saying. But why do you think when we are starting this particular course, we decide to spread it, even though we could have compressed the whole thing in one or two classes? The reason is this, that we teach a particular standard. I'm expecting that out of your leisure during the week, you will have made consultations, right? Make reference to the standard. I'm sure you did not check. That's why you don't have questions. Yeah, you did. And you understand everything in the standard. No, the standard itself. That revenue we did, how many pages was the standard? I will know whether you did or you did not. How many pages was the standard? Yeah. Like how many? Like 1,000 pages? 14. 40. Mr. K, you check. It's not 40, it's more than 40. It's about 60 something, 64 there. So please take time to, because that is the basic way. There's nobody, no way when you'll be taught that everything 100% in the standard will be mentioned. No matter how impressed you are by the teaching, there are still some things that will just be, maybe in the opinion of the presenter just felt that it is not relevant. Coincidentally, it could then be that part that relates to your own work. So if you have gone to check it and look at it again, you probably will have had an area that you either want to add to what we've done before or you want to clarify. Because even the standard setters, they are still going through what they have drafted and still say, this thing did not cover everything. Or, let's amend it again. So please, let's do. Allocation of fixed overheads, production overheads to the cost of conversion is based on the normal capacity of the production facility. We have earlier mentioned that, right? Normal capacity is a production expected to be achieved on average over a number of periods or season under normal circumstances. We've said in our earlier illustration that the normal capacity of this place is 1,000, right? So when we are allocating the fixed overheads, we will allocate it based on the normal capacity. We can then produce, depending on how we arrange it. And after we make the arrangements, it may not take up to 1,000. Or we arrange in such a way that it eventually takes up 1,500. That was why when you are using absorption costing technique there, you can then have over absorption of fixed overheads or under absorption of fixed overheads. You still remember? Okay. But we will not talk more about that because we are not in costing section. Sometimes a production process may result in more than one product being produced simultaneously. This is the case, for example, when joint products are produced or when there is a main product or a byproduct, right? So can you give me an example of any production process that would give rise to a joint product or a byproduct? Let me be as primitive as possible, but give me yours first. You're going too very far. Too very far. In a sawmill, in a sawmill, when they are slicing or smoothing those woods, those planks, we have something we call sawdust. I don't know which part of the country where you had during the days of Babasha.
Yes, sir.
Those things were the things we cooked with. It was a waste. Then, before that very period, you can go and pack anything. They will even be thanking you or give you money for packing it. But during that period, they were selling it. Do you understand? Hey, that was the name of Babasha stove. So also in the production process, you could eventually, the output could eventually give rise to two distinct or more distinct main products. Or incidentally, one main product and one byproduct. Do you understand? The standard later provides, we see it as we go on, that when you have a byproduct, the revenue realized from the sales of that or disposal of that byproduct will, because that is not the main product, it will be used in reducing the cost of our production. Invariably, the valuation of our inventory, even though it might not be very material. Do you understand? So take note of that. But if there are two main products and there are distinct ways to attribute the cost to each of the main products, then that one can just be accumulated separately. Otherwise, if it cannot be accumulated separately, such that the output just came up and we cannot say exactly this is what relates to this one, this is what relates to this one. What then do we use? We can then use realizable value from each of the products. If the total cost of production is 100 million, and one can realize 700 million for us, the other one can realize 300 million for us, we will apportion the costs by the revenue or value they can come up with. Do you understand? You will see where the standard talks about that. Now, trust me, if I will have to put forward everything within the standard, you will not, especially IFRS 9, you will not live here in. So what one could do is just to pinpoint the relevant sections of the standard, put more light on it, so that when you then go back to read on your own, it then becomes more meaningful. Is that clear? So this occurs when conversion costs of each of the products are not separately identifiable. I've just explained that. They are located between the products on a rational or consistent basis. Do you understand? What you could then use as your rationale could be maybe the value of the sales. Or from experience, that consistency could then mean that, oh, it is 2 kg to 8 kg that will be the cost contribution or cost incurred in producing the output. The most byproducts are immaterial, and costs of this sort are used to reduce the cost of the main products. I've also explained that. So still under measurement, you notice that everything we'll be discussing in the last couple of minutes has been how to measure. So where you could have real value from this is that when you then occupies a position where you have to make some decisioning around inventories, right? These are the factors that need to come to mind. Whether as an accountant, as an auditor, or whatever. Other costs are included in the cost of inventories only to the extent that they are incurred in bringing the inventories to their present locations and condition. Remember, I earlier said that we're trying to explain what cost is within the wordings of the standard. And it gave 3 components of the cost. It can be the cost of the purchase. It can be the cost of the conversion. Then it can be other costs. We have explained what will make up the cost of purchase. We have also explained what will make up the conversion cost, right? Then the standard is now saying that under the other costs, anything that will contribute to bringing that very inventory to the state where it can meet its intended purpose should be considered, right? So for example, it may be appropriate to include non-production overheads or the cost of designing products for specific customers in the cost of the inventories. So that is why using marginal costing then, it doesn't bother itself about apportioning the overheads on each output. Do you understand? It will just add all the variable overheads that relate to that production activity at one, because they are made contributed impact in having the expected output. Is that clear? All right, so examples of costs excluded from the cost of inventories and recognized as expense in the period they are incurred are: one, abnormal amount of wasted materials. Abnormality, that's where coming out of irrationality, right? Abnormal amount of wasted materials, labors, or other production costs. When you left last week, Tomiwa asked a question that I think if he had been here, he would have had more insights into what he asked. It was actually a practical scenario that happened in his place of work. I think they do manufacturing of certain branded shoes to some of their customers. So they made a production that the customer faulted. So they have to return and make a distinct one. The question then is, that cost incurred in making the faulted one, how will it be reported? The standard has cleared this, that this should not form part of your inventory at all, because it's abnormal. You are not in the business of making production and having major defaults. Not a minor one that maybe one or two is bad, that you have to just make correction. But everything was bad. So you have to expense it separately, not capitalize it as part of the inventory. Do you understand? A typical example is that you run an event management stroke catering services. Your clients requested for a wedding occasion, requested that you make certain food supplies, right? You did not get there until when the party is over. Even though, let's say you have so many other people you supply, how do you report? Because of course, the clients, if they had paid before, we claim refund. If it had not paid before, definitely will not bother to pay you. How do you report this? It's a distinct expense. You cannot capitalize it at your inventory.
Now, the shoe example, what if you can sell those shoes?
They are branded. You cannot sell it. If you sell it again, then you put yourself in further mess, because they will sue you. They are branded. If you can then sell it, let's say they are not branded. That's what you then see. You remember those days that you just be going, you will have seen a branded Italian shoe that when you want to buy is 40K and somebody is telling you 5K. It is when you now put it in your leg, you now notice that the leg is not straight. Okay, this is why they are selling it. You sure you understand?
Yeah.
Oh, this is why they are selling it for 5K. So that is just to reduce that waste, that expense they will have written off. So storage costs, unless those costs are necessary in the production process before a further production stage. If it is not relevant, then it should not be included. Administrative overheads that do not contribute to bringing inventories to their present location and condition, as well as selling costs. So carriage outward should not be there, delivery costs should not be there, and every other cost of that nature. So techniques of measurement, of course, we've given you various parameters, factors that you have to consider. So what did the standard say? When you then have to measure inventory, what are the techniques? The standard specifically provides two techniques. Standard cost method. right? That is why our discussion has to dovetail towards marginal or cost, or absorption, even though the standard did not specifically mention marginal costing, but you could, from related experience, you could know that that's what they're talking about. So standard cost method and the retail method or retail cost method. While the standard cost method is peculiar to those in the manufacturing industry, because that is where you will have accumulated all of those variable, the fixed, the overheads, and the likes. Just taking account of the normal levels of materials, supplies, labor, efficiency, and capacity utilization. Retail method is used in the retail industry. That's where you already bought a finished goods that you want to resell. So that is where the cost of transportation can be coming in, the cost of import duties can be coming in, other taxes incurred at source, which you will then consider whether there is provisions in the law that will allow you to recoup them or not recoup them. So these are the main techniques that the standard mentioned, right? Then the standard recommends the following as other methods of measurement of cost. Go and check the standard very well. Where you are mentioning LIFO, it's not in the revised standard. The standard only reckons with FIFO, first in, first out, weighted average, and net realizable cost. So that is why you will not see in Nigeria, within the context of IFRS, that we make reference to LIFO. While we were very used to it, you must have qualified the days of the ages when we were using SAS. That was why FIFO and LIFO and the likes was very fresh. You know, then the standard even say average method, weighted average method. Right. But within the context of IAS, LIFO is not there. The main methods are standard costs, the retail, then the FIFO as other subsidiary, the weighted average, the net realizable cost. But the concept of the net realizable does not come to play until when you are actually considering the option of whether the realizable cost of your inventory is not lower than its costs. If it is lower than its costs, then you will jettison every other method, whether FIFO, LIFO, and the likes, and using that, right? Otherwise, it will not come to play at all. Are we there? All right, so how do you recognize inventories? How should inventory be recognized? So recognition of inventory as an expense. Okay, when inventories are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which the related revenue is recognized. Initially, it is accounted for and reported as an asset until when depletion or obsolescence occur that makes the cost to be lower than, that makes the net realizable value to be lower than its costs. Until then, it will be reported at cost, which could be the standard cost, the retail cost, which other one did we mention? The FIFO, the weighted average, right? Until then, you will have assets. But when any of the following occur, you have now sold the assets. You have earned revenue. You need to match it with the respective expense, right? The standard then says, when inventories are sold, the carrying amount of those inventory, what is the carrying amount we are looking at now? The carrying amount, which could have been the standard cost, or the retail cost, or the FIFO, or the weighted average, or worst scenario, the net realizable value would then be written off as expense. The amount of any write down of inventories, so net realizable value, and all losses of inventory shall be recognized as an expense in the period of the write down or loss occur, right? So if you did not even sell, you can still report an expense, right? As long as the assets were not sold, it will perpetually be reported as an asset. But you then have the obligation to always check it for fair value. That was why we said that IFRS 13 has minor changes or impact on IAS 2, right? It is IFRS 13 that makes provision for that net realizable valuation. Is that clear? All right, so recognition of inventory as expenses still continues. Sorry. Yeah. Technically, we could also in the other class. And on the AC. move to now that is network here is very. Let's come in. The pi students, let's move the Okay. Okay, so the amount of any reversal of any write down of inventory arising from an increase in net realizable value shall be recognized as a reduction in the amount of inventory recognized as an expense in the period in which reversal occurred. So what we are then saying is that if you had earlier written down, because of the diminution in the value of the inventory, it's also possible that later on it then reverses, right? So when it then reverses, you should recognize it as such, but you should not recognize it above the cost or the original cost of the inventory, right? So that is what the standard provided with regards to recognition of an asset. Assets now we're referring to is inventory. We have also emphasized that for the presentation, you have to perpetually report it as an asset until when the expenses should be recognized, right? Then the disclosures of inventory as an expense. The financial statement shall disclose: 1, the accounting policy adopted in measuring inventory, including the cost formula used. We have talked about some of those cost formula. Can anyone remind us? That's not the main. Which one is the main? Okay. Okay. So you need to, at every point in time, disclose that this is the method used or the cost formula used in arriving at what you have presented. The total carrying amount of inventories and the carrying amount in classification appropriate to the entity, right? The carrying amount of inventories carried at fair value less cost to sell. Do you understand? So, but what the standard says emphatically is that when you are using a particular method, make sure that you use it not entirely for all the assets, but for every group of assets. Assets or inventories that have the same feature must have a common method. Then the amount of inventory recognized as an expenses during the period. So what portion? That's why we used to disclose our cost of sales, right? Otherwise, we will have just net it from the sales and report the net, right? But because the standard want to see the movement, how does your closing inventory changes from the opening inventory, taking into consideration the additions during the year? the amount of any write-down of inventory recognized as an expense in the period in accordance to paragraph 34, right? Then the amount of, the amount of any reversal of any write-down that is recognized as a reduction in the amount of inventory recognized as an expense in the period in accordance with paragraph 34. So that was where we are saying that you have written down in line with the net realizable value. What you have earlier written down, then reverses. Do you understand? Yes. So what you would then have to do is to use it to net what you have earlier expensed. But you have a cap. You must not recognize above the original costs. Then you have the circumstance or event which that led to the reversal of the write-down of inventories in accordance with the paragraph under consideration. What were the things that happened that made or calls for that reduction? Not that one is using that written down as a tool to managing tax or window dress the financials. Do you understand? Then the carrying amount of the inventory pledged as a security for liabilities. You could be owing some liabilities and you decide to use part or all of your inventories as a pledge for that liability. If anything occurs of that nature, you need to make those disclosures. Is that clear? Yep. Any question before we round it up? Because I told you it's a very short standard. The whole standard is just about 14 pages.
14?
Yeah.
If my question is in practice, I'm picturing Shoprite, the one that deals in inventory, lots of inventory. At the year end, they're playing the books and we want to test whether you're going to carry the inventory at the cost or at net realizable value. How do you obtain that net realizable value? I'm looking at Shoprite now, for instance, on the chief accountant in Shoprite.
Okay, so first of all, Shoprite will have an inventory ledger that keeps track of what comes in and what goes out. So, and for you to then look at that, one of the methods that we use is to look at what is the, most of their products are very perishable.
Yes.
So what is the life expiring date at year end of most of those products? If they are close to their expiring dates, then we know that technically they don't do anything about it now. They are as good as lost. The management could then say, for us to make this particular disposal as quick as possible, let's write off 50% of the original cost.
Okay.
Do you understand? So that's why you can see some products that are given away. Check the expiring dates. They are almost either they will not, under normal circumstances, they should not sell expired products. But maybe the expiring date is very close. And keeping it on the shelf, hoping that somebody will buy, may not come true. So rather than losing everything, why not just write off parts? So what they will then report as net realizable value is at 50%. Do you understand? Then the second thing is they do also sell some tangible products that may not be exposed to expiration. Okay. Sell AC, sell fan, and other tangible things. But those things also have stiff competition. New models. New models are okay. The last, when I wanted to buy that TV, I checked with Not coming up. I checked with some of those vendors, right? As you are trying to say, this is HD or whatever they used to call it. While we are there, another model came, they say it is curve. You know, ordinarily, people will go for the most, and that has a lot of impact. They will want to, as much as possible, quickly sell off the old stock. And that will warrant maybe reduction in the price. So that is another factor. Do you understand? Another factor could also be government legislation. Maybe you have an insight that something is coming up that will discourage the use of certain particular products. Like if there is any news that come up now that, oh, Nigeria will then have as much as 24 hours life guarantee. You will see how the gen and the plan, whatever, will crash. You understand? Just that they want to quickly exhaust the stock and look at something else, maybe solar or something. So those are some of the factors. They will look at what are the risks that their products are actually exposed to. Let me give you a typical example. Let's say they sell books, ICANN books, and they heard that ICANN is proposing to renew the syllabus. I know that in the next decade, those books will not sell again. They will give it out at a cheap price. So you will then have to look at what is the specific, the decision will not be across board. It should be product or group of products specific. So you now have to, if there is no risk, why are we? Do you understand? If there is no risk, you will perpetually report it as its cost. But if there are risks, could be obsolete, could be government legislation, could be competition, could be anything, could be expiration and all of that. We then informed what amount of loss can we absorb now to still at worst break even or minimize our loss exposure.
Okay, thank you. My next question will not be. Okay, there's write down, which will be reversed to the limit of the original cost. Okay, what if there had never been a write down? You have not.
You can't do write up.
You can't do write up.
If you do that then,
yes.
then it means you are not prudent. You know the concept of prudence. Say as much as possible, be eager to recognize all your losses. But as reluctant as possible, be reluctant or be slow to recognizing envisage gains because it's not realistic. Do you understand? It's not realistic. The only way you can then adjust for that envisage gain is to now hike the selling price. Increase the selling price. If you think that, oh, people will actually patronize you, increase the selling price. If you then, at the point you then fulfill your performance obligation, then you report your gain. I heard that window 11 is out now. So people in that line will now be struggling. Let's quickly exhaust whatever, because everybody will be looking out for window 11. But it is also industry specific. There are some industries that their inventory will never get obsoleted. Okay. To what extent does your telecom products get obsolete? I'm not talking about your infrastructural gadgets. MTN has always been MTN. Their stock of inventory has always been.
Now, what's inventory to MTN?
Is their if you understand the business very well, because what they are just selling is the air.
Exactly. Very fine. So what's inventory today?
They have like
It's okay.
yeah, model.
But those will be PPE.
No, it's still inventory. Yeah, it's still the device. The
Okay, what
device.
they are selling. To
My
you.
file.
Okay, yeah, that's true. That's true. That would be inventory. Okay. Okay.
Okay, so your own too, you have the router, the modem.
Okay. So their data now, can you call that one inventory? The airtime.
Yes, it is because there's a way it is being accounted for.
Okay.
There's a way it's just like you say, the water reserves for a company that sells water.
Okay.
Do you understand? But to an extent, because some of this particular thing is actually very much like a natural resources, what you will then put around it is the portion that have been harvested. Do you understand? So, and the machineries or facilities or equipment that have been used around it to putting it in a usable form. So they can tell you what could then convince us that it can qualify as such is this. They had harnessed certain portion using that their gadget and hair it out that we are selling this. So what would make you say that how many data band has been rolled out? So they have a metrics for measurement for measuring it.
Yeah, but that's when it's been sold.
No, not when it is so the one that have been harnessed.
So they have a place to capture.
If you have,
they can say we have 50,000 bandwidth.
Yes.
And they will be selling it, hoping to use up that bandwidth.
Of course. Abi?
Interesting.
So it just depends on the space where you are that will then inform what the metrics will be, how it's to be accounted for, and the like.
Okay, but now let us say part of the inventory is this your modem, or this your router, or your cable.
Cables will not be qualified as because they're
not
not.
just this cable, not just this
Fiber optic.
It's still that one is still not. It's still not inventory because they are not selling that. Their channels switch that will come under their own. No, that will come under their equipment or whatever. Because without those things, they are not selling those things.
So I will not say this out voice.
Exactly.
Okay, now that's accounting. From finance point of view, do they think you're a financial analyst too? Write down or write up of inventory. What does that do to the financial prospect of an organization? If, for example, you're a financial manager, not just an accountant. Yeah, you're looking at the financial ratios, the leverage, the total assets. You want to project a particular image of the company in terms of what we are doing in terms of total assets. Yeah. So how do you use that write down or the write up of inventory in your people?
No, I will not discuss. You know, I'm recording this. that is window dressing. But objectively, on the assumption that there is no invisible hand involved, objectively, your stock has impaired, and you have the management consent haven't certified it, and it has been approved that given these factors, we should write down, not with any intended or selfish interest. What it then means is that, of course, it will affect your gross profit ratio. So it affects your net profit ratio. That invariably means it will affect your efficiency ratio. All your efficiency ratios, you might want to.
Yeah.
All your majorly because it's profit prone. It will affect your efficiency ratio. Then your asset utilization ratio. By the time you want to calculate your fixed asset, your total asset turnover, it will affect it because to the extent of the written down, your assets will have reduced. Do you understand?
Yes, the right now, is there a right place to provide?
Provided it is objective.
Provided it's objective.
I have an asset.
Yes.
It is obsolete. Nobody is buying it again.
So the tax man will not have it back.
Will not have it back. They just want to pass that objectivity test. What is the parameter for you? Okay, look at that very other one we painted. We produce. It was a manufacturing error. And it is clear. We have incurred 70,000 or 70 million in that production. It's a loss. Who will buy it? It is not intended that we intentionally just make that error. Just the same way you have a waste. Do you understand? So what scenario they will say, we want to call for audit, we'll come and check, can we still have it there? Still there. And correspondent will show why the supposed customer rejected it. So you just have to pass, not making decision out of irrationality. That you just sit down like this and say, write this thing off. Right? Then time factor too will be there. Not that you bought something now and because you heard news, or even if it is rampant, they might still not approve it within that short time. Anything can still happen within that period. Or I was in one of my clients' office one day and they sell drinks, alcoholic drinks. So while they were arranging the inventory, one of those bottles just fell off. Boom! And it got broken.
One of them, okay.
And when I say one of them, one bottle is like, it's like 150k. This exotic drinks. So that's objective. You understand?
Yeah.
Even if let's say it didn't even get broken, but it got deformed, you won't buy it at the usual price you would have bought it. Or where you can vividly see that close to expiration. Rather than losing everything, or let's even say it has expired. How do we recover the money? So these are the things they will want to see to be sure that it passed that reasonability test. So if you can prove that this is why we're doing it, not just presumptions that some of the assumed variables imposed in IFRS 9 propose. Like when we get to IFRS 9, we'll then be talking about how you make expected credit loss. You kept money in the bank. Let's assume she has about 130 million in the bank 3 years ago. Till today, as of today, that 130 million does not have the same value. IFRS 9 will say impair it to the extent, at least to the extent of the inflation rate. So your 130 million, even though it's still there, when we go to check the bank, it's still 130. But IFRS 9 will have depleted it to the extent of the inflation. So when it comes to tax people, you say, your 130 is still your 130. Even though value-wise, it's not 130. It will not be accepted. Do you understand? So it should be disallowed. In the same way, you could then have, imagine you have $130 million 10 years ago in the bank. Let's even say 1,000. And as of today, you'll be dancing at me. because see that assumed gain, but until when you monetize it, it then becomes a realized gain. So that's why when you have exchange gain, accountants are always quick to recognizing that gain or losses. But in fact, we then prove further. Give us the schedule, the circumstance, the base that gave rise to this gain. Is it a realized gain or a notional gain? Like that very one, by the time we calculate the tax impact on it, you will say, I beg, just leave my money there. Do you understand? Because the money you are not seeing and you want to pay tax on it. The canon of tax is fairness. Where that gain has not been realized, it will not be taxed. So you should then do the company a lot of favor when we are reporting exchange gain to state that this gain arises from this. This is an unrealized gain. If you just report gain, they will tax it.
I want to invested gain realized.
Okay, so let's take it this way. I have products that I bought, the imported products. Let's say they are $100. And when we are valuing that same product today, a dollar is now 500 as against 150. How do you pass the entry? When you are doing your translation, you know the dollar was, the transaction was domiciled in foreign currency. So when you are translating it, you will then say $100 times the prevailing Naira, which will be different from your earlier book balance. So where do you pass the compensating entry to? Exchange gain. You understand? As at that point, it is not realized. It then becomes realized when you then sold it. Do you understand? So that appreciation in gain, as gain, will then be reported that it is realized. You get it? So other things are, you have cash in the bank, in a foreign currency too. $1,000, you didn't use it for anything. Until when you then withdraw and expend it for any business purpose, that assumed gain then becomes realized. You have a payables. Keeping it there, you will recognize the gain for your account to balance. It is unrealized. Now let's look at this. You have people you were owing payables, $100, as at when dollar was 150, right? So they now insist that you have to pay me today. And they wanted their money in dollar. You have to go and buy from a bookie and pay them. You have incurred the loss. If it is before the payment, as when you are translating it, whether gain or loss, it becomes unrealized. But when you realize is when you actually make the payment. In a reverse way, somebody is also owing you in dollars. So while you are expecting the payment to be paid, you are counting the egg with your teeth, or how did they say it? That that 100 to 150 has now become 100 to 500. It's a boy. It's still notional. But if the payment is now made today, it then becomes. So that is why the concept of hedging is usually used. When you then have the put option, the call options, the warranty, and the likes. Do you understand? When you then pre-agree, this is the rates we exchange. Any other question? This guy apologized that we had an unforeseen contingency for him to be away today. So even though he will miss today's class, he will not want to miss IFRS 9. You know, we are planning that as we finish, we will just jump. So, well, we'll just dedicate the next week to IFRS 9. It doesn't miss entirely because next week will be the last class.
Okay, the one you missed, right?
Okay, can we take it now?
I can go already. You want to take it now? Stop now. Okay,
Don't worry, you can confirm any time that's convenient for you. I'll make the makeup.
okay.
So, but any question on this?
Inventory. There was something I read some time ago, I think it's been a couple of days now, about one of these tech companies, whether HP or Dell, because of this write-down, write-off of inventory, they incurred a huge loss. A huge loss, whether it was HP